account insurance model is an example of a consumer-driven health plan. The Health Savings Account, or HSA, is exactly what it sounds like, a savings account that you open at your neighborhood bank where the funds can be used for health expenses. The benefit that makes it different from just a regular bank account is that the contributions you make are never subject to income tax. The model relies on consumers to take a more active role in their healthcare by shopping for competitive prices, making informed decisions, and overseeing their accounts. It relies less on the third-party payer and more on the consumer and provider to work together to determine what care is needed and how the care will be paid for. There are three main features that are key to understanding how an HSA works. The features are the requirements of eligibility, the characteristics of a high-deductible health plan, the features of the actual savings account. We will explore each of these features in order to better understand a health savings account. So who's eligible for an HSA? Well, there are 4 requirements. First, an individual must be enrolled in a high-deductible health plan. Second, the individual cannot be claimed as a dependent on someone else's taxes. Third, the individual cannot be enrolled in Medicare. Finally, the individual cannot have other health insurance coverage. So the first step to opening an HSA is enrolling in a high-deductible health plan. You cannot open an HSA without enrolling in a qualified plan first. For a health plan to qualify, the deductible must be at least $1,250 for an individual. Although the high deductible applies for most benefits, almost all HSA plans include first dollar coverage for preventative care. Also, like a traditional plan, HSAs have out-of-pocket limits. The out-of-pocket limits are $6,350 for individuals. Because the plans have higher deductibles, the monthly premiums are typically less expensive than a traditional comprehensive plan. The idea is that an individual or employer can save money on the lower premiums, use the savings to fund their HSA while receiving additional tax benefits, and then use the funds to pay for their healthcare expenses. So once you've enrolled in a high deductible plan, the next step is to open your actual savings account. You can simply go to any bank and open the special account and then start making contributions. The contributions can be made directly through your employer via direct deposit out of your paycheck pre-tax, or for an individual insuring themselves, they can simply deposit money into the account like they would a typical checking account and then deduct the money from their taxable income at the end of the year. Anyone can contribute to your HSA, including your employer, but the insured always owns the funds. So even if your employer contributes to your HSA and then you quit your job, the money they contributed is still yours to keep. Likewise, there's no use it or lose it feature with an HSA. Funds roll over from year to year, just like a regular bank account. The IRS allows an individual to save up to $3,300 a year. And there are also catch-up payments for people over the age of 55, allowing them to contribute an additional $1,000 per year. On top of the interest on your savings, most banks offer additional investment opportunities for your HSA, and your money can grow tax-free. So now you have your high deductible plan, you've opened your savings account, and you're ready to go to the doctor. How are you going to pay for it? Well, the bank where you open your account will issue you a debit card or checks connected to your HSA. So when you go to Walgreens and pick up your prescription, you would simply use your HSA debit card to make the payment. Because of the tax benefits conferred on your funds, you're only allowed to use your HSA to pay for a qualified medical expense, as determined by the IRS. Almost anything related to your healthcare is considered a qualified expense, including doctor's visits and prescription drugs. The 2 big things that don't count include over-the-counter drugs and insurance premiums. If you use funds from your HSA for a non-qualified purchase, such as over-the-counter drugs, the funds are not only subject to the income tax they previously avoided, but also subject to a 20% penalty tax. HSA can be an effective option for many people. Although the deductibles are higher than traditional plans, policyholders still benefit from contracted rates with providers through their insurance carrier. They also still have the benefit of access to first dollar care for preventative care. And at the end of the day, there are still out-of-pocket limits which help significantly reduce the risk for consumers. On top of this, an HSA gives individuals greater control over their healthcare consumption and allows their health savings to grow tax-free. To illustrate what this looks like, Jordan is going to analyze and compare an HSA plan with a traditional comprehensive plan.
We wanted to look at how an individual or family who chooses to self-insure on a state exchange under the Affordable Care Act might decide between a high deductible health plan or a more comprehensive plan. So what we did is we looked at the Illinois State Exchange and we looked at 3 Blue Cross Blue Shield plans. By virtue of being on the exchange, they comply with the Affordable Care Act, so the coverage is not going to be any different between the 3 plans, including, as Donna mentioned, that 100% coverage of preventative care. So if you look at the Bronze plan, your monthly premium is going to be $124 a month. Under the Silver plan, your premium is $181 a month, and under the Gold plan, $226 a month. What jumps out at you right away is the $6,000 deductible under the Bronze plan, $3,000 under the Silver plan, and under the Gold plan, $1,500. You also want to notice the coinsurance amount under each plan. After you hit your $6,000 deductible under the Bronze plan, the plan covers 100% of your bills after that. Under the Silver plan and Gold plan, more comprehensive, but it only picks up 80% of the bill. So now let's say you blow out your knee in a rec softball league and end up with a $5,000 medical bill. At first glance, you'd want to be covered under the Gold plan because you're only paying $1,500 of that $5,000 bill with your deductible. Under the Bronze plan, the more high deductible, you have the whole $5,000 bill. But if we think about how you can use your health savings account with that high deductible plan, you might change your mind. For example, if you considered the premium savings each month as a percentage of your higher deductible and you save that in your health savings account, you can cover those out-of-pocket expenses up front. So for example, the difference in monthly premiums over the course of a year between the Gold plan and the Bronze plan is $1,200. If you save that $1,200 in your health savings account, you've covered 20% of the higher deductible under the Bronze plan. Now, also, if you you have a responsibility for $1,500 under your more comprehensive plan, so let's say you save that amount in your health savings account as well. Between the premium savings and the lower deductible, you can save 45% of that higher $6,000 deductible in your first year. Now you'll notice that there are contribution limits to a health savings account that aren't going to cover your entire deductible. We have some recommendations for changing the law to allow max contributions equal to the deductible in your first year of having the health savings account. That would allow anyone who is worried about high out-of-pocket expenses to know that they can put the exact amount of their deductible in the bank right away in year 1. Another suggestion that we have is for those who self-insure under the exchange to incentivize them to use a health savings account. We could take their premium subsidies and offer them a match program to take what they would normally get in subsidies for their monthly premium and allow a dollar-for-dollar match to their health savings account. Again, this would incentivize people to save and control their health dollars. We just looked at the plans for an individual on the exchange. If you get your health insurance from your employer, you can also benefit from a health savings account plan, and Michael's going to talk to you more about that.
Thanks, Jordan. Despite hopes that the Affordable Care Act would decrease healthcare costs, premium prices for younger individuals and healthier individuals are on the rise, at least for now. According to a study by the American Action Forum, premiums for healthy 30-year-old individuals in all 50 states will increase from 2013 to 2014. These increases range from a 9% increase in Massachusetts to a staggering 600% increase in Vermont. For employers who offer health coverage to their employees, this is bad news unless they can find a way to offset these costs. Historically, the cost of providing non-HSA plans has been very similar to the cost of providing HSA plans. But if premiums continue to rise, this will likely change. HSAs can help to offset these costs to the employer. Essentially, instead of contributing money to an employee's premiums, the employer would have deposited the same amount of funds into the employee's HSA. This will shield the employer from rising premium costs while still providing them with before-tax deductions such as payroll tax deductions. Although this does shift some costs to the employee, the interest from the HSA will help offset this cost. As a matter of policy, one way to further offset the shift in cost to the employee would be to allow individuals to pay for their premiums out of their health savings accounts. This way, they, like their employers, will be less affected by the rise in premiums because they will be paying out of a tax-free interest-gathering account. Employers will also benefit from HSAs by having a healthier, more healthcare-savvy workforce. Studies have actually shown that employees with HSAs actually are 30% more likely to get an annual exam. Furthermore, studies have shown that individuals with HSAs are 50% more likely to ask about costs, 25% more likely to engage in healthy behaviors, 20% more likely to comply with treatment regimens, and 3 times more likely to choose a less expensive healthcare option. In this case, the employer benefits where the employee benefits. Additionally, although the costs of HSA-type plans are similar to the overall cost of traditional type plans, a study by the Society for Human Resource Management showed that employers who switched from PPO-type plans to HSA-type plans did in fact save money. Finally, employers can use HSAs to provide a tax-free retirement plan for their employees, as employees may withdraw from the HSAs once they reach the age of Medicare eligibility. Overall, employers benefit from offering HSAs to their employees by avoiding the rising costs and premiums while still creating attractive healthcare plans for their employees. Currently, contributions by employers to their employees' HSAs do not contribute to their required actuarial value under the ACA. However, it is in the regulator's power to change this. In conclusion, health savings accounts are a growing trend in the United States, with 13.5 million people enrolled in 2012, which is triple the number that were enrolled in 2007, which was only 4.5 million. The growing popularity and unique characteristics of health savings accounts make it an important factor in healthcare reform and the struggle to reduce the cost of healthcare while maintaining quality and accessibility. Thank you.